Well, Patrick, it's time for the WTF clip of the week, and there's no doubt what this week's has got to be. So why don't we just roll the tape?
All right, let's do it.
Good afternoon. This is James Cordier of OptionSellers.com with a market and account update for November 16, 2018. Needless to say, the events of this past week have been incredibly devastating for our clients, who I rarely call clients, around the office, and sometimes on phone calls, I refer to our clients as family. On what we call a new client call, I often thanked and told the new client that we were so happy that you were joining our family.
Shut the fuck up, Maffei. You did what you did. You got your money. But no amount I give to charity will help me atone in this business.
In the Wall Street Journal this week, it spoke on and on about the movements in the crude oil market and the natural gas market. It talked about the incredible volatility that cost funds and fund managers and hedge funds their livelihood. This rogue wave that I was unable to navigate has likely cost me my hedge fund. And the reason why I had a hedge fund is because you are clients. I promise you, every day when I woke up and I would check the markets, I was checking for rogue waves, and I truly invested your funds like you were family. I am so sorry that I was unable to manage the rogue wave that hit us this week.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone. It's gone. It's all gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
And it's gone. Okay. So
I
know we shouldn't be laughing.
No,
about
we shouldn't be.
Because there's although we got to kind of, and it's gone. We do have to laugh, Patrick.
We have to laugh at that, but listen, this is a very sensitive topic for me. I wanted to take this one head on because I would argue 15 of my 20 years of trading, I have been a premium harvester, seller of option premium on quite a large scale. Like that, this is something that encompasses a lot of what I do, and I've always said that it drives me crazy that people give this strategy such a bad rap. But then you look at what James Cordier did here, and you know where people get this impression, right? But it's amazing to me what he did.
Yeah. Actually, before we talk about what he did, can we just talk about the manner upon which he told everybody? I don't know, but if I get my account zeroed, I don't want to learn about it on YouTube. Okay. Yeah. And then and not only that, if you're going to go onto YouTube and do it, and listen, you have to give the guy credit at least for taking it. He took it head on, and obviously it's affecting him. And but like, take off the fancy watch and the slick cufflinks and stuff when you're telling your investors that you just lost all their money.
You could take the Rolex off, right?
That's right. You should take the Rolex off and be trying to give it to the customers already. So why don't you tell me? We spoke about this a little offline, and you told me about your two principles that you have in terms of selling.
Which clearly James Cordier didn't really follow.
So why don't you tell us about that?
When you're selling premium, you have to be one of two things. You have to be either diversified in what you're selling, or two, you need to be hedged on what you're selling, right? And so taking a massive concentration in one position simply creates too much tail risk. It creates that one event can ruin you.
Yeah.
And like I'm devastated when I see this. Like the thinking the people that the lives that were affected by this. I mean, he was clearly okay. So now when I was reading the article on Zero Hedge, they made it very clear in his letter that that he lost control of natural gas naked call options.
Right. So he owned up to that was the position that
In the letter, he
Okay, yeah.
basically made that known. But we were just kind of going in, doing some math in our head, trying to figure out what kind of a position did he have to have on to have zeroed out the accounts.
right, and we figured it was huge.
It had to be huge.
Yeah,
Right.
and
So I'm going to
'cause-
put up the nat gas chart for starters.
Right.
Right.
And while you're doing that, one of the things that after years of trading like a volatility book for a bank, I'm sympathetic because we were always short volatility. So I understand what chasing gamma is about, and I understand the risks that are imposed with this. And one of the things that always scared us was what we just spoke about with the geopolitical risk of the gaps. The gaps are what you can't hedge against. So when I thought to myself, okay, this guy, there must have been some huge gap in natural gas. Because if you have a gap, that's when you really get into trouble shorting vol, because you can't hedge at the discrete points that you see on the chart. You basically, it blows through your stops.
Right.
So I thought to myself, oh, their natural gas must have gapped up, 20%, locked limit, and it moved up and things like that. And then you pull the chart up, and
it traded right through it.
there's barely any
There
gap.
was one gap that was basically from 3 spot 35 BTU, and it gapped about 350.
Yeah.
So you're talking about a 15 cent, which was, let's say, a 5% gap higher. But the other price action basically traded straight through, right? There was no period where this was just like a 20% gap.
Yeah, so to me, it's just shocking. And he says that he had rules in place, and I don't know what the rules are, because to me, it seems like that you had a market that you could have executed within your risk tolerances.
So let's just go and explain, first of all, to our listeners what a naked call is. Essentially, a call option is the buyer has the right to buy this underlying security, and the counterparty has therefore the obligation to have to sell it to them if they wanted it
At a specific price for a specific length of period of time.
Exactly. And the buyer pays a premium. The seller receives the premium. Most people do this premium harvesting covered. But when you are naked, it means you're selling the call premium and do not own the underlying deliverable, which is you're taking the naked risk that the price will run away with on you. And so each futures contract is a 10,000 multiplier on natural gas, 10,000 BTU, right? No, sorry.
Yeah, no, you got it right.
No, it's 10,000 units.
Yeah,
and the price is, let's say, $3 BTU. Now
right.
it's 4.5, and so each at the time when he was selling, we went back and we looked. Actually, let's look at the chart. If let's say he was opening the at the money naked calls, this is just a chart of the prices of the nat gas for January contracts.
Yeah, so we just arbitrarily chose something.
Yeah.
And we said, if he was selling something, and like at the time, let's go back to the contract just quickly and we'll show where it was. And it was trading at roughly, 3.5.
Yeah. So let's say it's 330, 350 was the upper boundary of the zone, right?
Right.
So we're talking about, let's say, this level at 340 is the upper boundary
Right.
of the price.
So we were saying if he sold something that was slightly out of the money. So
350s.
So we chose the 350 calls, and we said, how much would he have gotten for selling those calls way back, a couple months ago when he was trying to do this thing? And so why don't we pull up the chart?
Yeah. So we were looking at it, and so he basically was probably getting 30 to 35 cents.
Right. So that represents.
So he's getting what, 3.5? Let's just 35 cents, $3,500 premium for every one naked call he's selling.
Right. So I like to do it as a percentage of the underlying.
Sure. Go ahead.
So it's 8.5%. So that's what
and that's just over a month of time.
Yeah. So he could earn 8.5%. by
On
selling
underlying
these
gas.
on these.
So which annualizes
Yeah.
very just under 100%.
Right. So actually, that's a good point. As we were wondering, is what sort of returns was he achieving in this account? It would be actually interesting to see that, because
Right.
it could be that
And
he
so
was, he
so
was
you
not-
and you have the natural contango in the natural gas markets, which basically has you rolling these types of option premium. So one of the things we were pointing out is that selling naked calls on nat gas was a lot like being short volatility back in January of this past year, where you were harvesting VIX premium, and eventually just one event creates this widowmaker event.
That's right. And we spoke about this briefly last week, about when we were talking about the natural gas versus crude oil trade, and the fact that there was such a positive carry in shorting crude oil, and that's implicit in the options as well.
Crude oil, nat gas.
No, sorry, in shorting nat gas, and that implicit carry is also in the actual natural gas, and it's also in the options market. It's priced in there. So shorting those calls was kind of juicing up the actual already natural carry. And so he was doing this and just kind of earning it over and over and over again until it didn't work. And the question was, what sort of, like, he had clients that were, and first of all, you have to understand, it wasn't actually a hedge fund that he was running, because it was a futures account that he was opening, or my understanding, I shouldn't say this, I don't know for a fact, but my understanding is it was futures accounts for customers that he was shorting those calls for them, because they woke up in the morning and got told, not only is your account zero, but you owe some money. Yeah. And with a hedge fund, that doesn't work that way. It's you're limited in terms of your losses, and that's all you can lose. But this was actually a futures account that he had discretion over, which is even kind of crazier that people were letting him do this.
So just to clarify a few more things for our listeners, right? So you could carry, I think we calculate, you could carry a futures contract on natural gas for about 15% margin. So you could, for give or take $5,000, carry this $30,000 futures contract, which is now worth like $45,000 because it's now like near $4.50.
Right.
And so the naked call could be carried for a very similar margin. And so he's turning around and harvesting 35 cents and needing to collecting $3,500 premium and only needing like $5,000 margin to carry this. Like, you could see the lure of wanting to profit from something like this, right? But what's interesting, and what we were asking, and how much of these contracts did he have open for him to zero out these accounts?
Yeah, it was huge, because think about it, the natural gas only moved 30-40%.
Right. So nat gas went from, let's just for some rounding purposes, we could say went from $3.50 up to $5 at its peak. Right. So we had a $1.50 rise on a 3.5 unit. Right.
Yeah. So that's like 42%.
40%. Right? Let's just round it to 40%.
Yeah. So which means he's got to have like 200 plus kind of percent that he's overwritten on these.
In other words, he took these clients' accounts, no diversification. And
you don't know. They could have been all sorts of negative short vol on some other stuff that also was like hitting the fan at the same time.
Yeah, because all asset classes are being hit right now.
Right, and
so clearly, what's happening here is that he was so over leveraged on this, trying to make these clients money. But really, there had to have been a decision. Because, okay, let's say crude oil, the nat gas goes from $3.50 to $4. And he might have been down 40% on these clients' accounts at that moment. But thinking that he can't have
he can't report that, 20%, 30%, 40%.
It's like that story you shared earlier with the trader putting the ticket into his desk.
That's right.
Like he was like, he just literally gambled with their money to say
he kept thinking it was going to come back.
He was going to come back,
and he did not cover it. What
if he even doubled down?
Well, we don't know. That's
no. I'm not trying to say I know this.
No, but
like if you're down 40% on the client account, and you think it's going to come back, do you add to the position?
Well, he definitely shouldn't be. But at the very least, I don't buy his argument that they followed their risk you
No.
know, because if that was the
You
case,
can't zero an account if
right.
you're following
The
risk
only
rules.
reason I would understand that is if you had a gap that it was so large that they were unable to hedge. But which means, like, if they're trying to tell me that they followed their risk and that they couldn't do it, either that or they were so large and they ran out of liquidity and they were the reason that the thing spiked. And that very well could be that they exacerbated the whole move upwards. I don't know how big the account. Like, he wasn't managing that much. It was a couple $100 million or something is what the rumors are.
But see, I look at it because in the way I look at the markets, I look at always not from a percentage, but I always look at it from an account size. So, you know, if I'm trying to do a yield enhancement and I have $1 million account and I'm turning around and say, I'm going to use these naked calls on nat gas to give my performance a kick, right? Now, if I just sold one naked call, and I kept rolling that on a month in, month out basis, harvesting 2% return on every 1 month call that I write, then, you know, you might turn around $2,000. Let's say you're making $2,000 a contract. You collected $20,000, $30,000 by the end of the year in premium. You just given your performance on $1 million account a 3 to 3% kick. See, that's diversified. You did it on one naked call contract. You did it as a little yield enhancement. But like, this is not yield enhancement. This is not like he didn't do this on one naked call.
Yeah, no, he must have been just balls to the wall. Like
Balls
all
to the
in.
wall.
Like there's
Balls
no.
to the wall.
I'm just really curious, like how well he was doing beforehand, because, you know, assuming this sort of volatility, like on the losses, I'm thinking the plus must have been great as well. Like,
But clearly for sure the
Like-
performance looks great until it's not.
that's right, and that's the thing about shorting vol is that's the way it works, and it just you make.
You
and
got to
then-
know when to walk away.
Yeah, and it's a difficult.
What it was interesting. Last chart I want to show, and we can you can keep going with your point, but I wanted to just actually just show what happened to the implied volatility on nat gas. And this is we were saying that this is not a big factor for because
Well, that's right. We were laughing because, you know, that's Vega, which is your, you know, sensitivity to the implied volatility. But if he was short and the move was so much that is actually
blew through his Vega.
He blew through his Vega, and it's all delta, meaning that it basically became 1 for 1.
it's the intrinsic value of
That's
how much
right,
he's in the
because
money.
he's, you know, $1 in the money or
Yeah,
whatever. So it doesn't
exactly.
really matter. But unless he was short all sorts of long dated stuff, but I just don't see that being a strategy. There is a chance that he was shorting all sorts of long dated volatility, and then his Vega would have been higher, and he would have been having some trouble. And you never know. We don't obviously know the position.
We don't know.
But you know, let's pull the chart up again because it is amazing. Like to get a feel for the craziness of the move over the last.
We went from
little
a 40% implied
Yep.
to 110%.
and that's on a commodity.
On a commodity.
And that's crazy. Like, very rarely do commodities get 100%. Like, you know, we used to laugh when stocks, every now and then there'd be one stock that would trade at 100, but a commodity is generally a lower. And
What was it? It was Tilray that had like the
300
300 or 400% implied.
They're definitely, but a lot of times those are just the near term.
Yeah,
ones
of
and
course,
the
the
long
near
term
term.
ones.
Yeah, of course.
But,
of course. It's
it-
always front money.
Yeah. So but this is just. It's an incredible story. It really is. It's going to be one of those ones.
You know what? I feel for the people that got hurt, but you know what? Him trying to be sympathetic to these people, saying that you're family. You know what? I'm sorry. That kind of risk, that was irresponsible. That you don't treat
Well,
family money.
Not only
way.
that, when I have something bad, tell my family I don't do it via YouTube. So
Fair
that, and you know what? One last thing, a parting note is that I'll tell you is that I remember talking to one of my buddies who was a commodity trader, and he told me a year or two ago that there was all sorts of this stuff going on, and that everyone around him was short volatility, and they just kept earning it. And this is a function of the quantitative easing, dampening down volatility, and making people search for yield in a lot of different places. And I suspect that this isn't the last of these stories, and you're going to find more of them going forward.
I'll agree with that. Let's move on.